Well, hey there, everyone. Welcome to Chart This with Dave Keller. Happy Monday, January 12th, 2026. I'm your host, Dave Keller, coming to you from a very rainy Redmond, Washington. It was awesome to be in Tampa last week. So good to see a number of fellow CMTs from around North America. Great to meet some new ones as well. Great presentations, thought-provoking sessions, and good networking all around. We had a great trip back. As much as I love the sun and sunshine, man, you live here long enough, you miss like the rainy kind of rain layer kind of days that we have here at Redmond. Probably a sign of being absolutely crazy, but good to be back here. There's a quote in the Stock Traders Almanac last week from Thomas Buck, who's a Barron's Top 100 advisor. I've always preached to my clients that how you do in bad markets is more important than how you do in good markets. Managing your risk is more important than finding avenues to make money. It's a corollary to one of my favorite quotes. Never confuse brains with a bull market. When things are going up, it feels like everyone's a rock star stock picker. Now is the time to not be complacent as we are threatening new all-time highs on the S&P and the Dow. Now is not the time to feel like 2026 is going to be easy. I would argue now is the time to just do a nice sort of wellness check on your stop losses, on your money management strategy. At some point, this market turns lower. I would not wait for that aggressive move down to think about what you're going to do in that situation. And I hope what we talk about on this show kind of helps prepare you for that. We're sort of bracing for a challenging day market-wise with the news over the weekend. On Sunday with the U.S. government or the Department of Justice subpoenaing Fed Chair Powell regarding the Fed buildings. The comments before the weekend, I believe that was Thursday or Friday, I want to say, with President Trump talking about limiting interest rates on credit cards. Comments like that could have set the stage for a really painful Monday. Ended up being not that bad. The S&P, the NASDAQ, the Dow, kind of sideways. Bread still okay. We'll look at the charts here together as we start our market review. As a reminder, 3 segments to the show. We'll start with a check on the market conditions as they went into the close today. We will look at the market carpet, which is a heat map style visualization to understand what's working and what's not. And then we'll finish up looking at some charts that I've hand selected through the course of the day today to highlight for all of you. As always, your questions are welcome and very much appreciated. We had a great all mailbag episode on Friday. If you missed that, please check it out on my YouTube channel. Answered some really thoughtful questions from viewers like you over the last week about different technical analysis, behavioral questions, different tickers, different strategies. I'm happy to go anywhere you like me to go. Please keep the questions coming using the comment section on our YouTube channel. All right, checking in on the markets today, as I mentioned, this could have been a really ugly day, and the market opened lower. So at the open, felt like, again, could be the beginning of a painful start to the week. Ended up being a nice recovery. Again, glancing down at the Stock Traders Almanac, kind of a traditionally bullish day. This January 12th, this first trading day of January, first monthly expiration week, as they call it, is usually up. And sure enough, it was. So we opened down around 69.40. We ended up getting up to just above 69.80, and we closed slightly below there. That's enough for the S&P to up 0.2%. The NASDAQ was up a little bit more. Mid caps, small caps, all in the green. This was not a big day. This is the kind of day that the VIX being at the level that it is, this would make me, this would feel like a normally expected kind of move. The S&P should not be having big swings according to the options market. The options market is pricing in low swings day in, day out. That's exactly what we're finding here, a low volatility environment. Now, even with the S&P slightly higher, the NASDAQ slightly higher, the VIX did drift a little bit higher. Today, it's around a 15 handle, 15.1. So still a low volatility environment by according to our work, but something to keep an eye on. At some point, the VIX pushes higher, pushes above 20. That's when I think you can be expecting some more significant moves, more likely to the downside than the upside for sure. Rates, again, kind of choppy today. The 10-year yield finished just below 4.2%. The long bond yield just above 4.8%. The TLT, which is a bond price ETF, down about 1/3%. The dollar slightly lower So stocks slightly up, bonds slightly down, kind of a quiet week overall. Perhaps this is the market bracing for earnings season, right? Earnings season starts out through the course of the week. It's a lot of financials here to start the week. JP Morgan, I think, coming out tomorrow. That is going to give us a lot of new information to parse through and think about financials in particular, given the recent social media posts about limiting interest rates for credit card issuers, with the Fed, and a lot of question marks in terms of Fed independence, Fed interest rate policy through the course of this year. Bank earnings could be pretty important to keep an eye on. Nice continued uptrend in gold. Nice continued uptrend in silver. The SLV was up 6.7% today. Gold, the GLD was up about 1.9%. We'll show you. Gold actually pushed higher, but came back toward the lows of the day, creating a bit of a shooting star candle. We'll show you that chart here. Not a huge concern. That's more of a short-term tactical kind of signal, but gold and silver continuing to push higher while stocks are holding their ground. Copper prices up, crude oil prices up, natural gas prices up in a big way. So the commodity space, generally speaking, except for some of the soft commodities like corn, had a pretty decent update today. Cryptocurrency is pretty mixed. If you look at the chart of Bitcoin for the last 24 hours, super choppy, sloppy. Bitcoin currently up about 0.2%. We're sitting just below 92,000. Again, for us, Bitcoin over 94,000 becomes a compelling chart again. Below there, it's sort of sideways. That's where I set an alert. Bitcoin at 94K. We'll let you know when that triggers in whatever show comes right after that moment. But for now, we're personally sort of holding off there. The rest of the top 10 cryptocurrencies in the red today, including Ethereum, which is trading toward the lows, where we've been here in the last 12 hours or so. Looking at the 11 S&P sectors, as I mentioned, breadth not bad, right? I mean, if you look at the sector breadth, that is, if you look at the 11 S&P sectors, you can see consumer staples up 1.2%, industrials up 0.8%, materials up 0.5%. Those are your top three sectors. So again, before we get all bowled up on what we saw today, consumer staples, arguably one of the more defensive sectors, if not the most defensive sectors, up 1.2%. I was taught when the going gets tough, the tough get eating, smoking, and drinking. So when you see defensive sectors like consumer staples popping higher, often a sign that someone somewhere, or a lot of someone's somewhere, are getting a little bit more defensive. Something to watch here, certainly as we go through earnings here in the next couple of weeks. Industrials and materials in the top three. Technology, number 4, up 0.4%. Only 3 of the S&P sectors down. Financials, not surprising, given the headlines over the weekend. Comments from Chair Powell yesterday pretty much felt like financials would be drifting lower today. And sure enough, only down at 0.8%, though, so that's not too bad. The energy sector, XLE, down 0.7%, even though crude oil prices were up slightly, and communication services down about 0.33%. We updated our market misbehavior premium members over the weekend with our weekly flight plan. That is our main investment report that we put out every week, only for our premium members. And talked about the market trend model remaining bullish yet again on Friday's close. So short-term, medium-term, long-term bullish for the S&P 500, according to our proprietary and very simple market trend model, looking at multiple timeframes on the S&P 500. Breadth overall remains pretty good. I mean, it's kind of a neutral breadth day. You can see, a lot of these numbers are kind of right around 50%. So this wasn't like an everything up, everything down or anything kind of day. This is sort of an in the middle. On the New York Composite Index, which is the most important universe according to our breadth work, more positive than negative. So 56% of stocks on that exchange up, only 42% down. So that's pretty good. But if you look at like the NASDAQ, the S&P, mid cap, small caps, more of a neutral reading all around. So this is not a big breadth day. Some differentiation, I would say, with the leading growth names, part of the Magnificent Seven and Friends. Broadcom up 2.1%. Alphabet, which has been consistently probably the strongest chart of this group, up 1%. Tesla up 0.9%, still trying to regain its mojo after a failed breakout over the last month. On the downside, Meta Platforms continuing to jockey against Netflix for the worst chart of this basket. I think Netflix is still the worst, but Meta looking pretty underwhelming, failing to get above resistance. I did grab that chart to just show you what has changed in the dynamics from a bullish phase to what I think we're in now, more of a bearish phase. Microsoft down 0.4%, about the same to the downside for Amazon. Not bad down days, but certainly not higher. All right, shall we look at the heat map? Please keep your great questions coming. Again, I appreciate all of you that shared questions for our mailbag episode on Friday. You can drop questions at any point on our YouTube channel. We'd love to hear from you, and we'll hope to answer your question live on the show on Friday of this week. Again, now that we're back here in town, plenty of normal publishing week, which sounds pretty good to me after traveling all last week. So good to be home. Good to be with the family here. And good to be coming to you from the home studio. All right, looking at the heat map. I mean, I showed you that breadth was pretty neutral, and this is what the heat map looks like, right? Kind of a 6 in one, half a dozen in the other, as my father-in-law would always say. Looking at the technology sector in the upper left, top three stocks: NVIDIA, Apple, Microsoft. I mean, not big movements. Now, after that, Broadcom, Oracle, especially having a pretty good up day. Oracle up 3.1%. Still not my favorite chart. Maybe just starting to rotate higher. That's the kind of chart I'd be looking at, like MACD or PPO, to see if there's enough of a confirmation of an upside rotation. But I'm looking at names like Qualcomm pulling back after an attempt to a new all-time high last week. Intel, which did make a new all-time high last week, pulled back after that new high around 3.3%. So not a huge day technology-wise. I mean, very mixed, right? You can see some stocks that were up, plenty of stocks that were actually flat to down. In the financial sector, and this is going into today, what it felt like there could be quite a lot of pressure, some challenges and expected places, right? Names like Capital One, AXP, these are the credit card issuers that stand to get hit pretty good if comments from President Trump would turn into some sort of broader policy change, limiting interest rates on credit cards for some reason. That would certainly hit the bottom line of a bunch of these stocks. So certainly some of those that could be more directly affected, pulling back pretty quickly. This is one of the risks of investing in equities in 2026, is that someone tweets something that hurts Capital One and it's down 6.4% the next day. That is a very real risk in this modern era of social media and wide instantaneous coverage. All right, elsewhere, quite a bit of mixed results all around, but I do want to just spend a moment talking about two sectors in particular. Number one, industrials. And again, I'm continuing to see defensive names like Raytheon just in these nice, consistent uptrends. I did not grab the chart of Raytheon. I grabbed another one, maybe FedEx or one of those that's in a pretty good, consistent uptrend. But, friendly reminder, the final thing I say at the end of every episode of this show is it's always a good time to own good charts. And I think of charts like Raytheon when I say that. Doesn't matter what you think about industrials as a sector, what you think about the broad market, what you think about interest rates, about inflation, about the dollar, about gold, about geopolitical issues. If the chart of Raytheon looks really good, in my book, you continue to maintain a position in Raytheon until the chart tells you it no longer deserves a place in your portfolio. I think investors can get into a lot of trouble when they try to anticipate things, when they feel like they know more than the markets. Remember, the markets are never wrong, right? Investors can be wrong quite often. So following the trend following, momentum investing, which is what we talk about, empowers you, right? Enables you to remain in a chart like Raytheon as it continues to appreciate. And that's what we want to find, are charts like that going up and to the right, what we would call long and strong charts. So quite a few of those in the industrial sector. Also, let's celebrate the consumer staples sector, right? Walmart making a new all-time high today. Costco nowhere near a new all-time high, but is very, very close to making a new 3-month high, which is sort of my initial sign of an upside rotation. A number of these charts that have been, frustratingly challenging charts for a while, starting to improve a bit. And I meant to grab Philip Morris and I didn't, so I'll talk about it here today. Philip Morris closed above its 200-day moving average on Friday. Today followed through to the upside, right? Anytime you have an initial break of a key resistance level, right? When you have a chart like PM breaking above and closing above the 200-day moving average, I always talk about, you want to see follow through. You want to see that next day having even further upside, which would imply that it wasn't just enough buying power, enough optimism to push above resistance. We want to push not just to resistance, but through resistance. After that breakout, what you want to see is additional buyers coming in, additional demand for that stock, people willing to pay even more than it was trading for yesterday. And that's what allows the trend to persist to the upside. I think we saw that today, which in my book means Philip Morris, a pretty compelling chart here, now making higher highs and higher lows. Momentum in a bullish range, pushing above 60 again today on that breakout. So strong chart, getting stronger in a nice upside rotation. So I've learned to not be afraid of charts like Dollar General, charts like Walmart making new highs. New highs often lead to further appreciation down the road. Just make sure you have a good money management strategy, a good stop loss in place. I didn't grab any of the miners, but just wanted to highlight in the materials sector, NEM, FCX. NEM, obviously one of the only gold miner in the S&P 500, and then FCX, more of a copper miner. Both making new 52-week highs today. So that strengthened gold and silver, strengthened metals, particularly the precious metals, continuing to juice some of those leading stocks in the materials sector. All right, let's finish off looking at some charts that I've hand selected through the course of the day here, and we'll go through them very, very quickly. And again, if any of these charts elicit some questions, drop a comment on our YouTube channel. We'd love to take a look. The chart of the S&P 500 now more and more clearly in the green light area. This is the we talked about this traffic light technique. When you have a market that's sort of range bound for a little bit in a consolidation, I think it's helpful to just sort of think about that range. Think about what it would mean for the price to go above the upper boundary, which is what we've seen here in the last couple of weeks. Think about what it would mean if the price went below the lower boundary, which I would say is in a red light area. We are out of the yellow light range into the green light range, which means tells me on the tactical time frame I'm bullish until and unless we break back below 6,900. Then I think it's back to a yellow light. We're remaining above this trend line that we drew and shared with you on the show here in recent weeks. Connect the November low to the December lows. That's just below today's low and the low we saw through most of last week. So we have the S&P pushing above 6,900. We have the RSI pushing above 60. That's all constructive. We did not close above 7,000, but very, very close to doing so. I've got the trumpet ready to go here. I would not say my performance quality is going to be at the level that I think any of us would want, but I will do my best to make a joyful noise on the show when we get that first close above 7,000. Could be as early as tomorrow. Breadth conditions have gotten better. Undeniably true. I wouldn't fight that, would not disagree with you. And I think that's been the case here for quite some time here, right? Back in mid-November is what I meant to say. If you look at the chart of the S&P, this is why things looked a little shaky, if not a lot shaky, right? The S&P at that point was below its 50-day moving average for the first time since the April low. The percent of stocks above their 200-day moving average down to 50% almost exactly, which tells you a lot of stocks have broken down their 200-day, and we're very, very close to tilting to below 50%, which was a key sell signal in early March of last year. Percent of stocks above their 50-day was getting down well below 50%, down into the 30s. So most stocks in the S&P below their 50-day. But in the weeks after that, all of that improved. The S&P went back above its 50-day moving average. The stocks above their 200-day held 50% and then started to drift higher. The stocks above their 50-day moving average now is pushed all the way up above 70%. So that speaks to how there's been a broad advance in November into December and now in early January, continuing that improved breadth condition. 100%, I would say that is a strong bullish argument. As long as we keep getting more and more stocks above their 50-day, as long as we hold it with most stocks above their 200-day, it's probably not a great idea to be too negative about this current market environment. I was talking with a number of the attendees at the CMT event last week about small caps. Here's the Russell 2000 ETF, ticker IWM, and you can see how we made on Friday a new all-time high. Is that true? A new all-time high? Hey, the good news is I have a charting platform with data. It was indeed a new all-time high for the Russell 2000 ETF. And I would say what happened here in early December was kind of encouraging, but we stalled out here. We broke out and then had this bearish engulfing pattern. Look at the up day and the big down day. We pulled back for another couple weeks, tested the 50-day, and then resolved to the upside. Now, we've once again pushed higher. So we're seeing stronger price action in small caps. And I think that is, part of that breakout story is the leadership, right? If mega cap growth is leading, small caps probably aren't breaking out. The fact that it's other sectors, right? Sectors like industrial, sectors like materials, like healthcare, These are sectors that are a little more wide financials. These are more widely represented in the small cap space. So if it's less of a growthy bull market, would not be surprised to see a scenario where the small cap index actually outperforms the large cap index. And you're seeing that here at the bottom, right? From mid-November to now mid-January, the Russell 2000 has been outperforming the S&P 500. Now, the trend has been against that for so long. I think so many investors are probably ignoring the small cap index, and I don't blame you, because it's not been a particularly good place to be. It's a good place to be today. Dow Theory, and this is classic old school Dow Theory. The Dow Industrials in the top half of the chart, the Dow Transports in the bottom half of the chart. Yesterday, for our market misbehavior premium members, we dug into a couple different angles on Dow Theory and what they mean. Generally pretty constructive here. And I would say traditional Dow Theory, this is sort of an adaptation of Charles Dow's original two sector indexes that he used. Breaking out, I think the strength in transports is one of the things that we did not see back here, right? If you look back here in August, September, October, the Dow's making new highs, but the Dow Transport's sort of languishing. And this is not the most important market timing tool I've ever learned about. But again, when you're looking for things that are not confirming the uptrend, I think that's helpful to just understand the dynamics. And transport's lagging so much was so telling. But if you look again from mid-November to where we're at now, Dow Transport's really accelerating to the upside. Some of the airlines actually don't look too bad. And Dow Theory giving a bullish confirmed signal here in January. Now, the reason why that's happening is because transports are really started to break out. If you look at the IYT, which is the transportation ETF, we can see resistance here around $73 on this ETF. Look at how many times we tested that resistance through the summer and fall of last year. We finally broke out of that range in early December. We pulled back to the 21-day EMA, and that sets us up for a January rally. Friday, we made the highest high so far in the IYT. Today pulled back a bit, but overall still a nice constructive uptrend. So nice breakout in transportation. That's the IYT we're looking at. I mentioned gold and silver making new highs. The chart of silver just continues to impress in such a great way. This is the chart of the GLD, and I just want to highlight this bearish candle pattern. This is called a shooting star candle, where you, in an uptrend, you have the open and close near the lows of the day. You have a long upper shadow, very small lower shadow. So what that means is you're in an uptrend, we open, we trade higher, but by the close, we're back down toward the lows of the day. So it's sort of like the opposite of a springboard, a hammer candle at the lows. If you flip that over, it's called a shooting star candle. It tells you the next 1 to 3 bars, probably lower. So maybe we get a pullback in gold and silver here to continue the week. But something to watch. Overall, new highs generally are bullish. Now, I'll tell you what's not particularly bullish are a lot of the big growth stocks, right? It's just not the leadership right here. And again, we've talked about that for a while, but I think putting some specifics around the technical patterns can be so helpful, and just understanding why this chart does not look as strong as some of the other charts we've already looked at here today. Here's Palantir Technologies, right? Sort of the poster child for this AI technology euphoric exponential rise we were celebrating all through most of 2025, certainly off the April lows. It's a big coil pattern, right? It's a sideways consolidation pattern, right? Higher highs and higher lows are bullish. Lower highs and lower lows are bearish. Lower highs and higher lows is a consolidation. It's neutral, right? We're going sideways. This is, sit on your hands kind of chart, a wait to see which way the market resolves. And remember that what's good about a coil pattern, or what's called a symmetrical triangle pattern, is the range sort of tells you we're at an equilibrium. The chart is telling you the market says this stock is worth around $185 a share. We're just kind of overshooting and undershooting that equilibrium. So think about it. We first hit that level in August. We then retested that level. We broke out a little bit. We came lower. We broke a little higher, broke a little lower. So it's sort of like there's the level, and we're just kind of rotating, kind of oscillating around that point. At some point, once we settle into an equilibrium, buyers take control and push us above the upper trend line. That's a bullish breakout. Or sellers take control, supply outweighs demand. We break down below the lower trend line. It's unclear on this chart which way that's going to resolve. And you can see with the momentum, right? The RSI is between 40 and 60. So we have neutral trend, neutral momentum. This is a sit on your hands kind of chart, wait for the break. And at some point, the price is going to break out of this pattern to the upside or the downside. And generally, the direction of that breakout is a sign of further momentum to come. At least that's the methodology that Edwards and McGee popularized in their famous book from the mid-20th century about technical analysis called Technical Analysis of Stock Trends. That's on our recommended reading list at marketmisbehavior.com. Home builders, I was talking with Jay Woods, had a great time reconnecting with Jay and many CMTs down at the Tampa event last week. I sat next to Jay for a while, and as it usually happens when two chart guys sit next to one another, we're half listening, but also just bringing up charts and looking, sharing each other's laptops, kind of pointing out breakouts and breakdowns and important things that we were seeing. Jay pointed out home builders. We were just talking about the choppiness last week, and Thursday is where you had this bullish engulfing pattern right at the 200-day moving average. There's Friday with the gap higher. So that bullish engulfing pattern really suggests short-term optimism. That was reflected with Friday's gap higher, and today a little bit further upside. So, encouraging sign for home builders here with a nice breakout, a new 3-month high, which I think is encouraging. And we'll see. I mean, next major resistance would be the September peak. That's around 120 on the XHB, but nice breakout, nice follow through today. We talked a lot about emerging technologies. As I mentioned last week, Kathy Wood was there talking, given a fire hose of bullishness about AI and emerging technology. So took the opportunity to dig into some of the different, kind of emerging technology funds that I'm familiar with. Defies Quantum ETF, QTUM, was one that I was taking a look at. Made a new all-time high again today. And this is sort of this really, to be honest with you, looks like what we would call an inverted head and shoulders continuation pattern. That's a mouthful of lingo. So let me break that down. Head and shoulders is where you have a head and two shoulders, right? It's a topping pattern, a higher high into the head, a lower peak. You break the neckline. And this is not here. I'm kind of drawing a fake line over here to show you what a head and shoulders top would look like. You flip that over, it's an inverted head and shoulders, right? Which is a bottoming pattern. Now, when you have an uptrend and then you have this big inverted head and shoulders, you call it an inverted head and shoulders continuation pattern. It's a continuation pattern because similar to what you would do in other places, right? You do the neckline, so you connect the swing highs here, and a breakout above that swing high tells you that we're pretty bullish, right? So here's the head, the left shoulder, the right shoulder. Here's a trend line connecting the swing highs called the neckline. We break above the neckline last week. We pull back. We appear to be bouncing off that neckline. That's called an inverted head and shoulders continuation pattern. Long story short, it's bullish. Basically suggests further upside. I often use that neckline as an initial stop, but I would also say things like the 21-day EMA, great for just sort of locking in any gains and minimizing a downturn, minimizing losses if there is a quick downturn. FDX is FedEx. This is a friendly reminder. It's always a good time to own good charts. FedEx is strong. I don't know if FedEx is the only chart I think that tells the story of this market, but how bearish do you want to be when FedEx, which basically gets packages out to everyone? UPS is obviously a similar kind of name. Amazon is another one of those, right? It's just a great gauge of consumer demand and things like that. FedEx is in a consistent uptrend, higher highs, higher lows. The moving averages are all sloping higher. The momentum is strong. The relative strength is strong. Would love to have charts like that in a portfolio at any point. Those are good charts getting stronger. Tell you what's not getting stronger right here is Meta. I just wanted to spend a moment talking about how Meta has changed, right? In July and August, think about what made this such a bullish chart. Prices trending higher, higher highs and higher lows. Pullbacks, getting the 50-day moving average and holding them. Momentum pretty good with the RSI above 40, mostly above 50 during that period. All of that changed after August, right? September, we have a retest of the previous high. So basically a double top pattern. But look at the RSI, not getting much above 60. So not that great demand that we saw back here when we're making new highs with the RSI above 70. That's a strong demand profile. This is a weak demand profile. Then all of a sudden we pull back, and instead of the RSI holding 40 on pullbacks, it's breaking below 40. Then all of a sudden here we're oversold. We gap below the 200-day. We're becoming oversold. We're staying there on this rally here to retest the 200-day. Number one, we don't get up above the 200-day through the entire month of December. That's tough. The RSI doesn't get above 60. So from this point on, it's like a tale of two charts, really a tale of three charts, because here's a distribution phase. Then there's this big accumulation phase, higher highs, higher lows, moving averages sloping up, momentum strong, relative strength strong. Then we flip that to downward trend, lower highs, lower lows, fail to hold support, fail to hold moving averages, which all start to rotate lower, momentum clearly in the negative configuration. And I would say that's still where we're at, right? The until Meta can get above that resistance around 675 to 680, until momentum can improve with a rally with the RSI above 60, until the relative strength can turn up, I'm much happier looking for other charts that are working. Certainly keep a watchful eye on the financial sector. Earnings season starts this week, and it's led by a bunch of banks, JP Morgan, Bank of America, others, all reporting this week. There'll be a lot of eyes on those reports. That'll be sort of initial sign of what to expect here. A lot of optimism priced into these stocks, and even though a number of them were down today after the news over the weekend, they're still in a consistent uptrend pattern, right? Bank of America is making higher highs and higher lows. The moving averages are all still sloping up. The momentum's good. So is there too much optimism priced into these stocks? That's where earnings can tell you a lot about the fundamental stories, right? Here we're seeing what the market is telling us, which is a lot of optimism, a lot of euphoria about the potential for banks in the quarters and years to come. Do earnings, sort of support that optimism that is reflected on the chart? And if not, these leading financial names could have a pretty painful rest of January, and that could put some pressure on the markets here because weaker earnings in this Q4 set of releases could finally throw cold water on this uptrend. Until then, though, strong market getting stronger. We'll continue to navigate these markets here on our daily market recap show. Thanks so much for tuning in. Thanks for following me and my work. If anything we did in 2025 helped you make a little better decision, help you understand the markets a little more, help you think about how you could improve your own process, I am thankful for that. And I will hope for many more of those moments here in 2026. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts. Have a good night, folks.